Assalamu alaikum wa rahmatullahi wa barakatuh. Good afternoon and good morning to some of the delegates. I'm very happy to have you here joining this webinar, Agriculture Insurance and India's Experience. The webinar is organized by the Federation of Afro-Asian Insurers and Reinsurers in collaboration with the Agriculture Insurance Company of India. As many of you know, agriculture is more than just food production. It is about stability, sustainability, innovation, and securing the future of many generations to come. As challenges like climate change, food security, and resource management continue to grow, the topic of today gains high importance. I hope that the shared experience and practices and technologies used by the Indian agriculture insurance market discussed during today's session will help us to gain knowledge and leave with practical insights and fresh perspectives that we can apply to deliver better coverage and high standards of services to our clients. We encourage you to stay engaged throughout the session, and please feel free to participate by asking questions or sharing views through the chat option in Zoom. Now, please allow me to welcome and introduce Dr. Lavanya Mondiar. Dr. Lavanya is the respectful Chairman and Managing Director of Agriculture Insurance Company of India. She has over 3 decades of experience in the insurance sector across India and international markets. Previously, as General Manager Technical and Chief Underwriting Officer at New India, she led the property, marine, and aviation underwriting and claims divisions, and was the first female CEO to head CEO GCC operations. While at New India Dubai office, she was board and committee members of industry associations, and in 2023 she received an honorary industrial doctorate from Emory in UAE for her contribution to the field. Dr. Mondier holds postgraduate degree in analytical chemistry, is a fellow of the Insurance Institute of India, and a certified reinsurance specialist from Singapore College of Insurance. Welcome, Dr. Mondier, and thank you for being here with us. I would like once again to thank all the participants who have been sharp on time, and I hope that you all benefit from this session. Dr. Mondier, the speech is yours now, if you would like to deliver a welcome note to the participants.
Thank you, Mr. Momin. It's a pleasure for us, pleasure and a privilege for AIC to be collaborating with FAIR for knowledge sharing sessions. So very quickly, Agriculture Insurance Company has been in India for 23 years. In fact, we just celebrated our 23rd birthday on 20th of this month. We have been working like an extended arm of the government and have implemented several schemes for the last 23 years. My colleague Vinod will take you through the nuances of it in more detail, but much more importantly, we have been a domestic insurer, and India being the third largest market in the world as far as agri insurance is concerned, we are very proud that we are in a position to be able to talk about the nuances of agri insurance to bring it to the global world, and more importantly in the African subcontinent, where there is so much of potential and possibility. In fact, I think it is just incidental that we got to meet as part of the GIC's workshop, and it's with immense happiness and privilege that I am happy to kick off this session. It is not just this session, I hope. I hope this will be the beginning of a series of webinars where we can discuss many aspects of agri insurance in greater detail. But today we will start off with an overview of largely what we think is the most important. Just one quick input that AIC handles almost 50% of the farmers of the country, and almost half of the business, agri insurance business in the country. We not only implement the center schemes, the regular crop insurance, but also we have a lot of parametric products. We also do retail products, and besides crop, we also do other allied business like livestock and livestock, blue water, uh, shrimp, and aquaculture, and various other. I mean, everything to do with the farmers, we do insure. We have the capability to do that kind of, not just pricing, product development. We have a lot of capacities to handle various, almost every aspect of a farmer's life, whether it is the crop or the associated things. So I will suggest also that the participants feel free to ask whatever, go into details wherever required, and also please correct us if we are going too fast, or anything is not clear enough, because it would be great to make this fruitful and valuable for both of us. Thank you so much.
Thank you so much indeed, Doctor. That's very insightful, and actually, it's really good that you have given us the broad scope of the services delivered by AIC. I have seen that it has been incorporated in December 2002 and started operations in 1st April 2003. So you correctly said that you celebrated the 23rd anniversary. Congratulations. Wish you so many successful and happy years to come. And in advance, Happy New Year as well to you, your family, and to all my colleagues at AIC. And I'm sure, Doctor, that you have a lot of busy schedule on your agenda, but I'm grateful for giving us this opportunity to be with us and to kick off this webinar. It's an honor, and thank you so much indeed. Have a great day, Dr.
Thank you so much, and all the best and best wishes to the entire program. Thank you so much. If you
Thank you.
permit me, I could log out now.
Please. Thank you so much indeed for being with us.
Thank you so
Thank you.
much.
Have a great day. All right. Now, thank you so much indeed for Dr. Mondiore. Her kickoff note was wonderful. I now hand over the speech and start immediately by introducing, or I will let you, please, Mr. Karna, to introduce your good self in a proper way to the speakers before starting the slides. Now, I have seen that we have 53 participants logged in. Thank you so much indeed. Please, Mr. Karna.
Okay. Thank you, Mr. Mukhtar, and very warm welcome to all the participants. Myself, Vinod Kumar Karna. I am working as a Deputy General Manager in Agriculture Insurance Company. So, as Madam has already told, that Agriculture Insurance Company is the largest market shareholder in agriculture in India. So today, basic agenda is we will take you through the basics of the agriculture insurance, how AICL is working in that, and what are the other achievements. So basically, we will try to go slow, but if somewhere you think something is not clear and participants want any suggestions, they can in between you can stop, or if any queries are there, you can put in the chat box so that we will try to answer all the queries at the end of the session.
Thank you so much indeed.
So thank you, Mr. Mukhtar. We will now start. I will share the screen now.
Yes, if you don't mind, sir, if you can, I will suggest, at least for myself, to make it a bit slower, if you don't mind, and also to introduce your wonderful team who is around you, if you don't mind.
Yeah. And along with me is Mr. G. Senthil, who is our technology specialist. So
Hello.
along with me, Mr. Senthil will be doing the presentation regarding the technology initiatives in the agriculture insurance.
Thank you so much.
So
welcome, sir.
okay.
Please, sir. We can see the screen, the presentation, Mr. Karna.
Is the presentation visible now?
Yes.
And voice is audible, I hope.
Yes.
Okay, so now we will start with this agriculture insurance. This basic topic is understanding the India's risk transfer framework and technology solutions. So in today's presentation, this is the agenda of the presentation. First, we will start with the AICL overview. Then basic principles of the agriculture insurance we will do. Then we will go through how crop insurance has developed in India and how at present it is performing in India. Then regarding the technology in the crop insurance field, what technological innovations are there in the crop insurance. And then finally, we will tell about the what AICL has finally done in the crop insurance field. So first, let me start with the agriculture insurance company. Agriculture insurance company, it has started its business in 2003. It is agriculture insurance is basically a sovereign company. It is made by the government of India purely for the purpose of agriculture insurance. If many of the participants must be aware that GIC is the national reinsurer of India. So earlier AIC used to be a part of the GIC crop division. So in 2002, a separate company was formed by the government solely for the purpose of crop insurance. And from the 2003, agriculture insurance has taken the work of the crop insurance. So we are issuing around more than 40 million policies per year. Plus our gross GWP has crossed 1.3 billion USD. And we are insuring around 20 million hectares yearly, plus more than 250 districts. Out of the pan-India coverage, we have a pan-India coverage. We have presence is there in the pan-India level in almost all the states. AIC is doing business in India, and almost more than 250 districts we are doing the business. And out of the total farmers we are covering, more than 7 million farmers are getting the claims. They are the benefited farmers. And total sum insured exposure of us is around 10 billion USD. And from 2000, in 2020, AIC has started the technology initiative in BSBY. BSBY is actually a scheme in crop insurance scheme in the West Bengal, where the scheme is based fully on the technology. So that is the first initiative where a full-fledged scheme has been introduced by the AIC in one of the states of India. And then from 2022, AIC has also started doing the allied line of business. Means we got the license of doing the allied line of business from 2022. We have also started doing business in allied lines where we are doing the agriculture related other insurance like cattle insurance and shrimp insurance, such kind of insurance we are also doing. So let me first start with the, before we start the agriculture insurance, let us see why agriculture insurance is actually required. So if you see, agriculture is a basic necessity for any country, any person, because agriculture is the field where actually bread comes. So these are the basic necessity. So farmer is a person who is a bread giver. So if that is a basic necessity, so we have to support the farmers. And with change in the climatic condition, now agriculture is becoming more and more uncertain. So this field is now developing in some developing countries. Still the structured scheme is not there. So out of all the lines of the general insurance, agriculture insurance, if you see, it is somehow more recent as compared to the other lines of business. In the recent past, in India, it has developed and structured up to a lot. But in some developing countries, still the scheme is still developing, and still full-fledged crop insurance scheme is not there. So if you see the agriculture insurance, some facts about the agriculture, Indian agriculture, then it supports around 42.3% of the population. So almost 42.3% of the population is dependent on the agriculture. And if you see the contribution to GDP, around 18.2% of the total GDP is contributed by the agriculture. So you can see the importance of the agriculture, how important is the agriculture. Then average growth rate of agriculture is around 4.18% per year. And total farm holding, if you see in the India, it is around 146 million. Out of this 146 million, only 40 millions is actually insured, which comes to around 27%. So what you can see, that still so much large number of farm holdings are there, only 27%, less than one third is actually covered under the insurance. So still there is a lot of potential is there where insurance is still not there. And if you see the farm holding, out of 146 million farm holding, 126 million, around 86% of the total farm holding is small and marginal farm holding. Means farm holding size is very small. It is up to 2 hectares or less than 2 hectares. So majority of the farm holding in India or in other developing countries also are of the small and marginal natures. So this makes the crop insurance much more complicated and much more challenging, because most of the farm holding, it is of very smaller size. Almost 86% is very smaller size farm holding. Gross cropped area of India is around 219 million hectare, and out of that insured area is only 62 million, which is around 28%. So you can see only a very marginal or minimum area is actually insured. It is still a growing field. And if you see the cattle population, 193 million is the cattle population in India. Out of that, you can see only 1% is actually insured. So why crop insurance is actually required? So first thing is, it is a primary risk management tool. Since, as I have already told, that agriculture is a thing which is a basic necessity, which creates the bread. So it is a basic management tool for protecting a farmer crops actually. So crop insurance is actually required because you have to protect the farmers, then only you can protect the agriculture. So agriculture crops has to be protected. Second thing, it protects against the losses caused by the crop failure, because with now climatic changes, the uncertainty in crops is very much there. So there are losses in the crops, and if you see the losses are increasing day by day with change in the climatic conditions. So to cover the losses and protect the losses, the crop failures, crop insurance, actually some insurance protection is required to cover that losses. Second, then third thing, it strengthens the cooperatives and agri-finance institutions. In case of agriculture, if you can see, most of the farmers are not so much wealthy. Their economic condition is not good. So many of the farmers, they are dependent on the agriculture institutions, financial institutions or cooperatives from there where they are taking the loans. So if they are taking the loans and there is a crop failure and they can't give back the loan, so this hampers the functioning of the financial institution as well. So with the crop insurance, that agri financial institutions and cooperatives are also strengthened because they get a support when loans are given. Their loans are actually insured. If crops are insured, loans are actually insured because that loans is used for the purpose of agriculture. Then fourth one is, it accelerates the adoption of new agriculture practices. Without any protection, there is no motivation or no support for the farmer to go for new agriculture practices. So crop insurance is actually required because it accelerates the new agriculture practices in the agriculture field. Then next point is, it minimizes the rural indebtedness due to the crop failure. If there is no protection to the farmer, then in case of crop failure, the farmers become, they don't have any financial support in that case. So crop insurance is a tool which protects the indebtedness of the farmer in case of crop failure. Plus, you can see if there is a crop failure or there is a production is not good, there is a drought condition, then government has to do expenditure. The government has to release the grants, government has to spend money. So that when some grant is given by the government in case of crop failures, mostly it is unplanned budget type of thing. Means there is something which can't be planned beforehand by the government if there is no protection at all. So there is a failure in the crop, so government has the unplanned expenditures. So in case of crop insurance, if there is a crop insurance scheme going on, then there is a planned expenditure. So government can plan the expenditure beforehand. So even in case of calamities or any crop failures, there is no unplanned expenditure on the government side. So it reduces the government expenditure as well, and the relief measures also it supports. Then keeps the farmers' income, continuing the farmers' income and buyer power. So if protection is there to the farmers, farmers can become wealthy and they have more income, they have more buying power. It promotes the economy as well. So next point is, it ensures the prosperity of the country. And finally, the farmer, which is the bread producer, it maintains the dignity of the farmer. So this is why crop insurance is actually required. But why crop insurance is still developing, because there are challenges in the crop insurance. So first we'll see how crop insurance is actually different from other general line of insurance. If you can see, this is the comparison between what is the difference between general line of insurance and agriculture, because agriculture insurance has some peculiarities. If you can see, these are the basic broad differences, if you can see, between the general insurance and a crop agriculture insurance. If you see the general insurance, it covers the broad risks which are mostly predictable. Like you are doing a motor insurance, property insurance, these risks are mostly predictable. But in case of agriculture insurance, it protects us against the farming risk. And farming risk, as you know, farming is very much dependent on the climatic and weather conditions. So uncertainty is always there in the farming risk. So where general insurance covers the broad risk, which is often predictable, the agriculture insurance is against the farming risk, which is mostly uncertain, or you can say it is more uncertain as compared to the general insurance. Then you see the coverage scope. When you go for the general insurance, the coverage scope is very broad. But when you come to the agriculture insurance, it has a specific agriculture focused coverage scope. Then you see the target group. In case of general insurance, there is a wide target group. Your group size is very huge. Wide target group is there. But in case of agriculture insurance, your target group is actually farmers and persons who are engaged in the farming activity. So your group size is some focused group size is there. Then in general insurance, there is a diverse range, product range are there. You can have different type of products. But in crop insurance by typical nature, only few schemes are there. I will show in the next slide why actually crop insurance is challenging and why there are not so many type of products in the crop insurance. Then predictable nature, I have already told that in general insurance, most of the risks are predictable as compared to the agriculture insurance, where due to the weather risk, the risks are much more unpredictable. Uncertainty is much more in case of the agriculture risk. So what are the main challenges? Means when you are designing a crop insurance, why crop insurance is more challenging actually. So in case of crop insurance, first thing is there is a lack of historical data on yield and crop losses. As you all must be aware, when you are implementing any insurance scheme or when you are designing an insurance product, actually for doing the pricing, for doing the loss cost claim ratios, you require a historical data. Based on that historical data only, actuarial analysis can be done, pricing can be done, so that how much premium you will charge, that can be decided. So in case of agriculture or crop insurance, the historical reliable data is not available because it is more recent. So whatever data is there, in some countries, still data is not that much good data, good quality data is not available. Even if we see in the India, in the last 8 to 10 years, data quality has improved. But before that, the data quality is not that much good. So there is lack of historical yield data or crop losses, because earlier there was no system of proper recording of yield losses and yield data. So this makes the crop insurance programs, designing of crop insurance, very difficult, because if you don't have a historical database, it becomes very difficult for any insurer to design a product, how to price it, and how to do analysis regarding that. Then second thing is, agriculture has a wide variety. There are a wide variety of agriculture practices. Agriculture practices varies from area to area. Same type of crop may have different productivities in different areas. Different areas may have different climatic conditions which may affect the yield. They have different agriculture practices as well, which can affect the productivity. Some farmers may be having better irrigation facilities. Some farmers may not be having that much facilities. Some practices are good enough. Some have high yield variety. Some have traditional varieties. Even if you see in case of India, if you see the wheat production, it ranges from 2000 kg per hectare to 5000 kg per hectare. So from area to area and state to state, there is wide variation in agriculture practices and also the productivity of the crops. So a simple product can't fit in all the fields. All the areas will have different kind of requirements because there is different agriculture practices. So this makes the crop insurance designing much more difficult. Then third thing is paying capacity of the farmer. If you see the crop losses, historically, if you see the crop losses normally goes above 10% to 15% crop losses if you see the historical data. But if you see the farmers community in most of the countries, mainly in India and other developing countries, the farmers' economic position is not good. So paying capacity of the farmers is not good. So if you're charging 10% or 15% from the farmer, actually farmer economic condition is not that much good that they can pay the insurance premium. So when agriculture credit is available at around 7% in India, and even after if you government gives a subsidy, it comes to 4%. So giving premium rate of 10% or 15% is totally uneconomic from the point of farmer. So even if protection is there, our target customer, which is a farmer, he don't has the capacity to pay that premium. So this makes the product more challenging because what product we are designing, that product target customers don't have the capacity to purchase that product. So what is the solution for that? So solution for that in agriculture insurance, mostly agriculture insurance are supported by the government, where government gives the subsidy. Government subsidize the product because farmers don't have the paying capacity. So farmers pay some marginal amount of the premium and rest of the premium is actually shared by the government. Because without subsidy, it's very difficult for the farmer community to take the insurance. So this makes the crop insurance very, very challenging. Then next point is loss assessment techniques. In case of crop insurance, there are very challenging things how to assess the losses. Losses can be assessed either on the individual basis or on the area approach. First, let us cover the individual level analysis of the losses. So in case of individual basis, if you go in the general insurance, if there is a loss, suppose a building is insured. So how you assess the loss? You go to the building, there is some loss, you go and see the building, you do the survey, you see how much losses are there and you pay the claims. But in crops, if you go to the individual level, so as you see, there are so many farm holdings. Farm holdings are in billions. So all the farm holdings insurance, any insurance company can't visit all the farm holding to do the individual assessments, because if they go for the individual assessment, the administrative cost becomes very high. So almost the claim ratios, if you calculate historical claim ratios, it comes to around 10 to 15% total loss ratios. And if you add the administrative cost of doing the individual assessment, it makes much more uneconomic. So it's not possible to do individual assessment of each and every field. Administratively, it is very difficult to do, and economically also it is not viable to do individual assessment at farm level. So what next? So what is the solution for that? The solution for that in agriculture insurance is the area approach basis. What you do in the area approach basis, you make the homogeneous area of same agroclimatic areas. Homogeneous agroclimatic zones you define. Means what insurers assume that in same type of homogeneous agroclimatic areas, if same climatic conditions are existing in that area, the same if one type of crop must be suffering almost same type of losses. So in area approach, what happens? Area approach, we do a certain area and all the farmers of the area are assumed to having the same risk. So if losses are there, all the farmers insured in that area will get the claims. If losses are not there, none of the farmers will get the claims. So from the administrative time point of view, area approach fits the crop insurance, but it has another demerit that many times the individual claims may be different or it may vary from the actual claim, which is assessed by the area approach methodology. Because many of the farmers may be having some different losses of the same area itself. Suppose there is a Gram Panchayat. In Gram Panchayat, under the area approach, whole Gram Panchayat is assumed to having the same losses. But in the same Gram Panchayat, some farmers might be having better irrigation facilities, so they might not be having any losses, or some farmers may be having much more losses, because area approach does the assumptions that all the farmers are suffering same losses, whereas in actual scenarios all the farmers might not be having the same losses. So this is one of the challenge, how loss will be assessed in case of the crop insurance. Then next point is unique identification is not possible in case of crop insurance. When you are doing other general line of insurance, then you identify your subject of insurance. You know you are insuring this vehicle, it has a particular identification number. You are insuring some building, you know this is the identification of the number. But in case of crop, if you are insuring crop in a field, so in one field, there can be thousands of the plants. You can't put a separate identification mark on each and every plant. So suppose you are insuring 1 hectare field. In 1 hectare field, there are 1,000 plants. So you can't go and tag each and every plant. You have to insure the full field. And in full field also, you don't know how many plants are there. At the time of insurance, there can be 1,000 plants. In between, if there is a moral hazard, some plants they can destroy. That it is very difficult for a insurer to see whether any moral hazard is there or not, whether subject of insurance is same or anybody has manipulated that subject of insurance. So unique identification in case of crop insurance is very difficult. You are insuring the crop, but you are relying on the field where that crop is actually grown, and actual identification is not possible in the crop insurance. So if you are going for an individual approach, then chances of moral hazards also increases in case of crop insurance, because first thing is identification is not possible. And then when you are going for the individual approach, at the time of losses, if anybody does any manipulations in the field, it is very difficult to establish what manipulations has been done, because individual identification of individual plants is not possible in case of agriculture. Plus, the next thing is, since crop insurance is a much more recent line of business, so there is lack of trained manpower for the loss assessments. If you see in field, in market, trained manpowers are actually not easily available who can go and do the loss assessment, because loss assessment in case of crop insurance is basically and majorly done by the I estimation method when you are going for an individual approach. So I estimation method, loss estimation, it requires a technical skills. So that skilled manpower is actually lacking in the field. People don't have experience and they don't know how to estimate the losses by just looking at the crops, how much production goes down. That estimation requires skills. That skill set is not available. So lack of trained manpower is one of the major challenge when you are doing the crop insurance. And plus, one of the most difficult reasons when you are doing for a, I will tell about multi-peril and named peril things. When you are doing a named peril type of insurance in case of crop insurance, then it is very difficult to know ki this losses is attributed to which peril. There in crop losses, there may be multiple perils which might be operating on that field, on that area. And if you are going for a single peril, like you are going for a hailstorm cover, then any crop damage, it's very difficult to attribute that this damage is due to hail, or it is due to frost, or it is due to any other pest or diseases. So this is also one of the major challenges in designing a crop insurance product, due to which crop insurance become a one specialized subject which requires a technical skill set and technical manpower for designing the product, as well as implementation and loss assessment as well. So what type of crop insurance systems are there? So crop insurance system, if we can bifurcate the crop insurance, different type of crop insurance system. First one is traditional crop insurance systems, where there can be named peril type of crop insurance or multi-peril. Named peril, mostly it operates in US and European countries. The named perils operates. There, the insurance is for a particular peril like hail, frost, excess rains, or fire. So any losses happening due to some specific peril is only covered in that named peril. So crops are covered for some specific perils. If losses are due to that perils, then only claims are payable. Otherwise, claims are not payable. So in case of named peril, the loss assessment is mostly and almost in most of the cases is done on the individual basis only. But in their risk is always there, that it is, as I have already told, it is very difficult to segregate how to justify that losses happen due to this peril only there, because there can be multiple perils operating on the losses. So first thing is named peril, then second one is multi peril. Since named peril has a challenges that it is very difficult to attribute, then multi-peril is much more convenient and much more reliable in case of crop insurance. Multi-peril covers all the perils which are operating, crop losses happening due to any of the perils. Multiple perils, it is like a comprehensive cover which gives a coverage against the risk of drought, flood, hail, diseases, insects, everything. Means there can be multiple perils operating, and ultimate losses, if it is happening, then that will be covered. So traditionally it can be bifurcated into either named peril crop insurance or it can be multi-peril crop insurance. Then second one of the bifurcations can be index type. Index type means in case of crop insurance, you losses are linked to some index, like it is linked to the yield index. If crop losses are there in the crops, then ultimately productivity of the crops will go down. So what we are doing, or what insurance company does, they measure the productivity of the crop. If productivity of the crop it goes up, it means there is no losses. If productivity goes down, it means there are losses. So some benchmark is fixed. That benchmark is the normal productivity which is assumed for a particular crop in a particular area. Compared to that benchmark, if productivity for a crop in that particular area goes down, it is assumed that there are losses in the crop. If doesn't goes down, it goes up, it means there are no losses. So yield acts as an index, and losses are estimated based on the yield index, and it is one of the most common and one of the most reliable methodology in the crop insurance. Then second thing, it can be weather index. Weather index is actually a derivative kind of insurance product where there is correlation is established between the weather parameters and the crop production. So different crops may have different requirement of the weather parameters. Like it may require different temperature in a particular season. It may require different rainfall, how much rain it is required, sunshine hours it may have. So their correlation is established. How much rainfall or how much temperature is actually required in a particular area for a good production of a crop. Based on that based on that weather parameters, triggers are fixed by the insurance companies. If triggers, suppose there is a trigger of 100 mm rainfall, we know that if rainfall is less than 100 mm, the production of a particular crop goes down by 5%. So what happens? We will fix a trigger and we will say key less than this, if trigger goes below this particular weather parameters goes less than that particular trigger, it is assumed that there will be losses in the crop. So based on that, multiple triggers or single triggers can be fixed for a particular crop in a particular area. Triggers can be, it can be rains Rains is one of the major factor which affects the crops. It can be temperature and it can be humidity as well, or it can be combination of multiple factors. So multiple factors can be taken of the multiple weather factors which affects the crop yield can be taken, and triggers are fixed for that some weather parameters, and based on that parameters any deviation from the benchmark, actual means actual weather conditions, deviation of actual weather condition as compared to the benchmark fixed by the insurance company based on the correlations, based on that losses are assessed. It means any deviation as compared to the triggers, fixed triggers of the actual weather incidences will result in the payment of the losses, payment of the claims. So this is one of the methodology. Like one is the yield index where productivity is directly measured for assessing the losses in the crops. Other one is the weather parameters is actually fixed, which can be linked with the crop production and productivity, and it can be used as a trigger to see how much losses are there. Third one is crop health index. Crop health index is much more recent phenomena where crop health is actually established. Crop health is, it is if satellite imagery based kind of thing. Crop health is based on the, there are various indices like NDVI is there, which is normalized difference vegetative index. Then there is a leaf index. NDVI is actually greenness of the crop based on the texture of the crop. If you capture the crop imagery from the satellite, the textures of the crop can give the give you the idea how much healthy is a crop. So based on the satellite imagery, or you can use the drones also, based on that NDVI can be measured, which gives the greenness. You can measure the leaf area index. It means ki how much area of leaves are there as compared to the total ground area, or soil adjusted vegetation index, or you can measure the moisture index, soil moisture index. So all these indexes can be measured, and based on that you can combine the various indexes, or you can have a one individual index, because if greenness is more in when you are capturing the imagery from the satellite, it is assumed that crop is of healthy nature. So based on the index you can fix one methodology, you can fix a benchmark ki below that index the crop is supposed to be having low productivity, below that it is above average or it is average. So you can fix the index for a particular area, benchmark index, and that benchmark index can be compared with the actual index for the season, and losses can be assessed. Other thing, you can see the give the range. Means you can actually tell ki this much NDVI is actually required to be having for a good crop yield, and you can measure the NDVI for a particular season, and then you can compare that NDVI with the actual required NDVI or actual benchmark NDVI which is there for a healthy crop, and any deviation from that can be used as a loss assessment measurement. Based on that loss can be assessed. So, and then there can be multiple triggers can be set, which can be combination of yield index or crop health index or weather index. Means multiple triggers can be used. Then third one is hybrid. Hybrid is index plus, where what I have told earlier, weather and named peril. Here weather insurance along with some named peril. Suppose we are covering a weather parameter, plus along with that we can cover a wind speed also. Wind speed we can go and we will do the individual assessment, plus weather parameter based one weather index product is also there. So you can club both the products, where weather indices will also be there, plus named peril will also be there. So one kind of that is index plus, that can also be used. This is also called a hybrid product. And of late there can be a revenue based insurance product as well, because in case of agriculture, as you all know, if agriculture production is too high, then also prices go down. So if you see the economic condition of the farmers, if production is too high, then also income doesn't grow in the same proportion in which the production is actually growing. Because as the production goes above a certain limit, the value which farmer is getting is actually coming down. So in revenue based, what is happening? The production along with the market price which a farmer is getting of its produce, both are combined, and actual revenue is estimated based on the production and the market price which is going on. That is combined, and that is compared with the some benchmark revenue which is required and which is a normal revenue, as if you calculate based on the historical yield data, that is compared, and any deviation for that revenue, that will be used for assessment of the losses. So I think I am clear. If anybody has any questions in between, they can ask as well, or they can put in the chat also. Okay, shall we go ahead?
Yes, Mr. Karna, thank you so much indeed. This is very insightful, the introduction. And I have a couple of questions on the chat. So I don't know whether you would like to hear them now or at the end of the session.
I think we will see all the chats at the end of the discussion.
Okay. Then we'll keep them all at the end. Thank you so much indeed, sir.
Okay.
Thank you.
So let's go how crop insurance scheme are actually designed. So in a country, when a crop insurance by its nature, since crop insurance is a very wide scope, so any crop insurance scheme has to be designed. So these are the basic framework how crop insurance scheme is actually designed in a country. Because normally crop insurance, when it is implemented as a larger level, it is implemented at a country level only, and some scheme has to be designed. Otherwise, small crop insurance products are there, but that products are not that much successful. So this is the basic framework of designing a crop insurance scheme. So in designing a crop insurance scheme, first one is the critical elements which you have to consider. So in critical elements, what has to be covered? First thing is what perils has to be covered. So in perils, as I have already told, one thing is it can be named peril or it can be multi-peril. So when designing an insurance scheme, first we have to say whether we have to go for some specific perils or it has to be multi-peril. If we tell by our experience, multi-peril is always a better option, because in case of crop, as I have already told, it is very difficult to attribute a particular loss to some specific peril. So it's always better to go for a multi-peril. So at the time of designing, any company or any government or whoever has to design has to first see the critical element, what perils it wishes to cover. Then comes the second thing, when you are doing the insurance scheme, how losses will be assessed. Means, is it on the individual basis assessment or it is on the area approach basis? Individual means ki each of the farm holding which you are insuring, you are in case of losses, a surveyor will go to the individual farmer's field and do the assessment. Or other one is area approach basis, where you make the homogeneous agroclimatic zones. You assume that all the homogeneous agroclimatic zones will have the same type of losses. If you see from the administrative point of view, area approach is a better option to operate, but it may have demerits that actual losses may be different because it will have a normalized effect. So it can be individual or area approach, or it can be combination of both as well. Means some specific perils can be covered at individual levels, which are perils which are localized in nature. I will tell in the next slides that how in India PMFBY is operating, where it is a combination of both actually. So some perils can be covered at individual basis, and overall area approach basis can be set up. So at the time of designing a crop insurance, it has to be decided whether we have to operate at individual basis or if we have to operate at the area approach basis. And mostly, if farm holding size is small, difficult. If in case of developed countries and countries where farm holding size is big, they are operating on area approach basis, individual approach basis may be convenient, but in areas of countries where farm holding size is very small, they are operating on individual approach basis may be quite challenging and difficult. Then third critical element which has to be decided is whether you are going for a voluntary coverage or a compulsory coverage. Because when any crop insurance scheme is implemented in a country, I am telling from the government point of view when you are doing crop insurance scheme. Otherwise, voluntary and compulsory don't have a question. If it is implemented by a government, then whether government has to go for voluntary in nature or compulsory in nature, because each has its own merits and demerits. In case of voluntary, there is always a chances of moral hazard, because farmers who are more prone to the risk may take the insurance coverage. Areas where riskiness is more coverage will come from that areas. Areas where riskiness is less coverage will come or no coverage will come. So that will increase the premium rates. Second thing, if it is a voluntary nature, then moral hazard chances are also high. In case of compulsory nature, all the farmer they are covered, so risk is uniformly spread throughout the area, throughout the state or country. So in that case, in compulsory nature, risk is equally spread, so their moral hazard chances are less. But in case of compulsory nature, the demerit is that many farmers actually don't require the insurance coverage because they have some irrigated facility. Their crop production is almost there. That is a good enough. They don't want the insurance coverage. They are not having the any losses in the historical past, or whatever losses are there, they are capable enough to bear that losses. They are also covered. So there can be dissatisfaction amongst the farmers who are actually in a better position, or who are a better off, have better economic positions. They may not be motivated to go in a compulsory coverage. So both has its own merits and demerits. So anyone who is implementing any schemes, when it is to be implemented, it has to be thoroughly thought of whether it has to be on the voluntary basis or it has to be compulsory basis, and there should be some balance that whether it has to be compulsory or voluntary. Then after it is decided, then comes the key elements. Means after you decide what it is, the basic structure or skeleton of the scheme which comes in the critical elements, then come the key elements. After designing, how it has to be, how scheme has to be operated in there, what are the factors. First thing, which farmers are covered. There can be multiple options. You can cover all the farmers who are taking loans from the banks. You can cover the farmers who are of some particular income group, or any category of farmers can be covered. That has to be incorporated in the scheme. Then which crops are to be covered, because when you decide on area approach basis, in that cases you have to see how losses are assessed. Suppose some losses are assessed based on the productivity of the crop. So when you are covering the crops, you have to ensure that productivity of that crop is also measured on some authentic way that is acceptable to the population. So which crops are to be covered, that is also one of the factors which has to be decided in the key elements of designing a crop insurance scheme. Then comes the next thing, what will be the sum insured? Means how much sum insured will be given to a farmer, means for a particular crop. That has to be decided. There can be different methodologies for defining the sum insured. Mainly sum insured, in most of the cases, sum insured is defined as per crop per hectare basis. Means for a specific crop, how much sum insured has to be given for a unit insurance area, that is the sum insured. So how much sum insured has to be given, that has to be incorporated, and sum insured should not be too high so that people will start making profit, and it should not be too low so that even in the case of losses, it cannot support. So it has to be decided very judicially how much sum insured has to be fixed for a specific crop, and it may vary from area to area depending on the requirements of the crop. Then comes the premium. How much premium you are going to charge for the crop insurance scheme? As I have already told, that normally farmers don't have that much strong economic position. So how much premium you are going to charge from the farmer? What will the premium rate? Whether it is insurable or not insurable, because if there are some crops where premium rates is coming too high, then it may come in the category of uninsured or uninsurable crop. So that has to be decided how much premium has to be charged, and there comes the challenge also, because premium is mostly decided based on the historical yield data and loss statistics, which is mostly it is not available on a very good quality in case of agriculture in most of the countries. Then comes the loss assessment methodology. When you are implementing the scheme, how you are going to do the loss assessment, whether you are going to have an individual basis loss assessment, or you are going with some weather derivative kind of thing, or you are going with the yield index or crop health factor. This has to be decided how losses has to be assessed, and for that losses, what will be the procedures. Full procedures has to be decided how loss assessment will be done, and finally, who is going to finance this crop insurance? Because crop insurance, if government is supporting, how much subsidy government is going to give in this scheme, and that subsidy is applicable to which group of farmers, and how much subsidy for how much subsidy in which areas, that has to be decided in key elements. So once you decide the skeleton, then you decide the key elements of the scheme, and this comes the whole scheme. And other requirements which is required for the designing is historical data. As I have told, it is required for the purpose of pricing. It is also required when you are designing the sum insured, how much sum insured is viable, then how you are going to implement this insurance scheme, what are the channel partners through which the scheme reaches to the farmers, trained manpowers, whether it is available or not, how manpower availability can be made, how they can be trained, and after implementation, monitoring is also one of the main factors. Then what we have planned, it is going in that direction also, that proper monitoring is also one of the major requirements when you are implementing a crop insurance framework. So this is the basic crop insurance scheme framework in case of when you are designing a crop insurance scheme. So now let's go how crop insurance has evolved in the India. So this slide shows you how crop insurance actually evolved in the India. So if you see, crop insurance started way back in 1972. In 1972, GIC, that is at present National Reinsurer of the India, it has implemented crop insurance on H4 cotton. In 1972, when it was implemented in India, this 1972 H4 cotton scheme was actually individual based scheme. This was individual based scheme, so coverage is very limited, and it was not that successful due to administrative reasons. As I have already told, that implementing a scheme or individual basis in country like India, where farm holding size is small and numbers is very large, assessment is very difficult. So that scheme was not successful. It was on a limited basis only in 72 for H4 cotton. Then in 1985, government introduced CCIS. This CCIS is Comprehensive Crop Insurance Scheme. This scheme is based on area approach basis. In area approach, what government has done in this scheme, some specific areas, individual agroclimatic homogeneous areas are decided. Based on that areas, all the farmers will be getting the same type of claim. Means some particular yields are benchmark yields are decided, and yield for that season is estimated after the doing the crop cutting experiments. Actual yields are taken, then actual yields are compared with the benchmark yields for that particular crop and area, and any deviation in that yield is used as a parameter for deciding the final claims. So that was the comprehensive crop insurance scheme. There, the premium, the sum insured was fixed at around 10,000 rupees, Indian rupees at that time, and the premium rate was different for different means. For cereals, it was around 2% and 1% for oil seeds, and there was subsidy sharing between central and state. So in 85, that scheme was there, but that is also on a limited scale only. Then comes the 1999. In 1999, on a broad level, pan-India basis, Government of India introduced National Agriculture Insurance Scheme. This is one of the first step where a pan-India level scheme has been implemented in the India. This is also area-based scheme, and AIC is implementing that scheme because at that time in 2000, earlier it was done by GIC, then 2003 onwards AIC started doing this scheme. So National Agriculture Insurance Scheme is also area-based scheme, but in that scheme the upper sum insured limit was removed by the government. So now that is linked with the loany farmers. Whatever loans farmers are taking, that full loan is covered by the government under this insurance scheme. In this, the subsidy, the premium rate for farmers are at very minimum price. If you see if I tell about the premium rates, it is around 3.5% for bajra and oil seeds and 2.5% for kharif crops, because kharif is a more uncertain season. Kharif, as you know, it is a rainy season, so crops are mainly dependent on the rains. So for kharif season, it is either 3.5 for bajra and oil seeds and 2.5 for other kharif crops. And for rabi crops, which is a winter season crops, the rates are 1.5 for wheat and 2 for other rabi crops. So in 1999, the NAIS implementation started, and that was area approach based scheme. In this, the liability of the government was also on the claim side, because premium charged by the farmer is 2.5, 1.5, and final liability of the only AIC was implementing. So whatever claims are coming, 100% of the premium claims up to 100% of the premium is the liability of the AIC or implementing agency, and claims beyond 100%, suppose 100 rupees is the premium and claims beyond 100 rupees, that is shared equally by the central and the state government. So ultimate claim liability above the premium are going to the government. So government is sharing the liability of the claims. In case of annual commercial and horticulture crops, the liability of the insurance company was up to 150% of the premium, where actually premium rates were actuarially charged. Means actuarial premium rates were there for the annual horticulture and commercial crops, and other crops where premium rates were fixed at the lower level by the government. At that, only 100% of the up to premium is the liability of the insurance company. Above that, government is actually acting as a reinsurer kind of thing, where above 100% of the premium, government is coming in the picture, and state and central government are sharing equal liability of all the claims which is going above that 100%. So that scheme continued up to 2016. So in 1999, that National Agriculture Insurance Scheme which started, it continued. It is area approach based scheme where assessment are done on the, and each states have their own implementation. They have different areas, notified areas where they are implementing. It is the notified area is at mainly at the tehsil level or block level. Means all the farmers of some particular tehsil, or later it was shifted to one level lower than that, which is revenue circle. So all the farmers of a particular area are assumed to having the same losses or not any losses at all. So in that case, there is some dissatisfaction also among the farmers, because in the same areas there may be different kind of conditions existing. So in one block, in one tehsil, farmers may have different losses. So what is the solution? So ultimate solution is that notified areas instead of higher level, notified area should be at the lower level. So the lower level the notified area is, the more actual will be the claims, because if you are going at the higher level, all the claims of the adjoining area will be normalized with the higher claims, will be losses will be normalized with the lower losses. So in 1999 that NAIS was there. Then in 2007 AIC introduced weather-based crop insurance scheme. This is a parametric product where correlation was established which weather parameters are affecting the crops. Mainly in that, temperature, rainfall and humidity are the factors. In rainfall, whether excess rainfall is there or deficit rainfall is there, temperature and humidity. And each crop's correlation is established how much these weather parameters are affecting the crop yield. Based on that crop yield, triggers are set for different crops in different areas, and losses are assessed based on the deviation of the actual weather conditions as compared to the benchmark triggers fixed in the weather-based crop insurance. So this weather-based crop insurance started in 2007. Then comes in 2016 when government introduced Pradhan Mantri Fasal Bima Yojana. This is a much advanced and a better version of the NAIS. Government has made certain many improvement in this scheme, and year on year improvements are still going on. This NAIS, this PMFBY, Pradhan Mantri Fasal Bima Yojana, if I translate in the English, it is actually Pradhan Mantri Prime Minister Crop Insurance Scheme. If we can translate in English, it is Pradhan Mantri Fasal Bima Yojana or Prime Minister Crop Insurance Scheme. This scheme is yield based as well as parametric, because WBCIS was also covered under this scheme, but WBCIS, whether based on the weather parameters, losses are assessed, and mostly the scheme is yield based scheme, yield based, yield index based, plus along with area approach, there comes this some individual perils based scheme also was introduced in PMFBY. So along with the area approach, individual approach scheme was also merged with this. So in PMFBY is a combination of individual plus area approach scheme. So 2016 starts the beginning of PMFBY, which at present is being implemented in India, which is one of the very advanced and very structured kind of thing. And each year government is making some improvements in the scheme based on the feedback from the ground. So this is the PMFBY. I will just run a quick audio for that. Is the video visible? Is the video visible? So is that audible? Okay, shall I continue? Mr. Mohammed, is it audible now from our side? Mr. Mohammed? Hello, Mr. Mohammed?
Mr. Karna,
Hello?
yes, I'm sorry. I just needed to go quickly to the boys' room. I'm sorry.
Yeah, am I audible now?
Yes, I'm available now.
Okay, continue.
Thank you.
So I will got.
I was listening actually suspectly to the presentation, and I have noted down the questions, responded to the also to the participants, but I just needed to quickly for a relief. So the natural code. Thank you.
Okay, I will
I'm with
call.
you now.
The screen is visible. Screen is visible, I think.
Yes. Objectives of the PMFBY, and I can see you very well. And now we are having 80 participants actually, so I'm happy.
Okay, objectives of PMFBY you can see on the screen.
Yes,
Now.
I can see that. Yes. Yes, I can see, sir. I can see. It's very clear.
Just a minute.
Now I can see you. The presentation has been removed now, right?
Yeah, 1 second. 1 second. 1 second, we are sharing. Actually, we can't see.
Yes, I can see now. Do you want me to share from my side, sir?
No, I am sharing. I am sharing.
Okay.
You can see now?
I can see now, yes. The mountains?
Okay.
Yes.
Yeah, objectives of PMFBY, you can see that slide?
I can see now, yes.
Okay, I will start.
Thank you.
Okay, so now we will start with the PMFBY, that Pradhan Mantri Fasal Bima Yojana. This is present implemented in India as a crop insurance scheme. So first I will start with the objectives of the PM scheme has been introduced. So first objective is to provide financial support to the farmers of crop losses due to non-preventable risk. This is the first objective. Then second objective is to stabilize the farm income, that ensure continuity in the farming operations, especially after severe crop losses. So even in case of severe crop losses, the income of the farmers must be stabilized. So this is one of the objective of the PMFBY. Then third one is to encourage the modern agriculture practices, because without
Mr.
production
Karna?
it is very difficult for the farmers to go on support to the farmers. So to promote, to increase productivity, this is one of the major objective of the PMFBY, and to ensure flow of credit to the farmers and encouraging them to adopt progressive farming practices. In last but not the least, the objective of the PMFBY. So basic features of PMFBY. So these are the basic features of the PMFBY. First one is the premium rate. Under PMFBY, the farmer's premium rate has been fixed at the very, very low rate and uniform rate throughout the country. So what has been done in this scheme? In earlier schemes, there used to be a different rate for different crops, different seasons, different crops, different rates were there for the farmers. So it was creating confusion and it was difficult to communicate with the farmers of the premium rate. So under PMFBY, what government has done, they have introduced a uniform premium rate for one season. So for Kharif season, it is fixed at 2% of the sum insured for all the crops. For Rabi season, it was fixed as the 1.5% of the sum insured for all the crops. And for commercial and horticulture crops, it was fixed at 5% of the sum insured for all the commercial and horticulture crops. So this is the premium which a farmer is going to pay for any insurance coverage. Under PMFBY, what change government has done as compared to the NAIS, in case of NAIS, when farmer were paying premium rate of 2% to 2.5%, any claim beyond the premium is being borne by the government, which is shared by the central and state government. So in that case, subsidy is actually on the claim side, where government is giving the support when claim payment is being done. Under PMFBY, what government has done, the subsidy portion is introduced in the premium. So in this PMFBY, implementing companies in under PMFBY, government has allowed other insurance companies as well. Private players are also allowed in this scheme to participate in this scheme, and premium which companies are charging are being charged at the actuarial rate. So whatever the premium rates companies are estimating based on the historical data of the area, that premium rate actually actuarial rate is charged by the insurance company. Out of that actuarial rate, farmer is paying this flat 2% and 1.5%, and balance between the actuarial rate and this farmer premium rate, that is being shared by the central and state government equally. So what government has done, out of the total premium, government is giving subsidy in case in premium instead of claims which government was earlier doing in case of the NAIS, National Agriculture Insurance Scheme. So here if premium rate of a particular crop in a particular area is coming to 10% and it is for a kharif crop, then difference come to 10 minus 2, 8%. So 8% is the subsidy portion which insurance companies are getting, but that is being given by the center and state equally. So 50% is being given by the center, means 4% will be given by the center and 4% by the state. And in case of northeastern states, government has given incentive that center is sharing actually 90% of the total subsidy. Means if 8% is the total subsidy, out of 90% of the 8 means 7.2% center is actually bearing and rest is being borne by the state government. So here farmer premium rate is very less. Then PMFBY, it is giving a comprehensive risk coverage. Means all the losses happening to any of the perils, it is a comprehensive risk coverage. The risk coverage is given for crops from the time farmer is thinking about sowing the crop. Means ki it starts from the time crop is being planted to sow up to the point when crop is being harvested and it is put in the field for drying purpose. So end-to-end coverage is being given under PMFBY from the time the this agriculture thing process is started by the farmer in the field up to the end of that agriculture process. This end-to-end coverage is being provided in the PMFBY. So from the time it is sowing up to the time of harvesting, full coverage of risk or coverage of risk against any of the peril, means losses due to any of the perils. If losses are there, the claims will be given. So this is one of the factor. Then government has made a national crop insurance portal. This is a centralized portal. This portal gives access to all the stakeholders, where insurance company will have the access, where farmers have the access, channel partners such as banks have the access, where persons who are willing to do the insurance, they can go to the portal, they can put their insurance details there. Insurance company can see the details from the portal and access the data of their coverage. Then loss assessment yields which are used for the assessment of losses, that is being entered by the government in the portal itself. Subsidy is shared in the portal. So it is a central one point solution for all the activities, and data is also being structured and data is also very efficiently managed. And now though all claims are also distributed by this portal only. So whatever premium is coming, that premium is coming through this portal, and claims final is also distributed through the portal only. So it is a one point solution. NCIP, National Crop Insurance Portal, is being introduced by the government, on which this PMFBY scheme started implementing. Plus, in PMFBY, what more features they have introduced is technology. Under PMFBY, government has introduced CC Agri-App, where technology is being used, Stock models, weights. These all are technology initiatives where technology is being used either to do the loss assessment, plus they have also started using technology for the coverage of farmers as well, because farmer can be covered through the app, loss assessment can be done through the app, yield methodology based on the technology, yield assessments are done. So technology has been introduced in this scheme, and PMFBY gives a basic feature that states have the facility to take the cover type of cover also, because I will show in the next slides the liability of the states. Means in a scheme, the sharing of the subsidy or how much liabilities of the state is also decided based on the different models of the scheme which is being provided in the PMFBY. This is also one of the features. Plus, under this PMFBY, one basic cover government has given, one basic yield based cover will be given to all the states where it is a compulsory nature, plus some add-on covers based on the individual approach any state can opt, and that individual approach claims can be clubbed with the area approach based schemes. Plus, earlier WBCH, which I have told in earlier slides in 2007, which was introduced, that WBCH was also made on the same lines of same premium rates. Only thing, the crops where crop yield data is not available or there is no proper methodology for assessing the yield productivity, and where coverage is not possible under the PMFBY, there states can opt for restructured weather-based crop insurance scheme. Means ki crop losses are assessed based on the weather parameters. So this is also one of the portion of the PMFBY. Actually, it is a separate scheme, but with the scheme, all the premium rates and everything is similar to the PMFBY in case of WBCIS. Only thing, the crops which are not cannot be covered under the yield index base can be covered under the WBCIS, where weather parameters and triggers are decided, and based on that, loss assessments are being done. So what crops are covered under this? Almost all the crops which are grown are covered under PMFBY. And basic thing, if it has to be PMFBY yield index, which is actually, if we say about PMFBY, it is a yield index where productivity of the crop is measured, and based on the productivity only, the crop losses are assessed. So in case of PMFBY, all the crops grown where crop cutting experiments mean that crop cutting experiment is a process through which productivity is established. So all the crops of a particular specific areas where some minimum crop area, like suppose 25 hectares government has fixed. If crop is grown more than 25 hectares in any area, that can be notified by the government, and only condition is can be measured. So all the food crops, cereals, millets, pulses, oil seeds, animal, commercial, horticulture crops, and perennial crops, all the crops that are covered in the scheme. So this is the product structure of the PMFBY. So as I have already told, the cover starts from the time the farmer is doing the sowing up to the time harvesting is being done. So what has happened? First cover is the prevented sowing. So first cover is prevented sowing. In this case, if a farmer is planning to sow or he has sown the field, but actually due to the adverse weather condition or due to the drought or some conditions, the sowing can't be done. Means he is prevented for sowing, or there is a failure, germination failure. Means his crop seeds are sown but it is not germinated, so there is a failure. In that case also, this scheme gives the cover losses claims to the farmers. How these losses are assessed? In case of prevented sowing, government decides. First, I will tell you the basic structure how PMFBY is actually operating. It operates on the area approach scheme. So government decides the notified area. Notified area is the area for which all the farmers will be assumed to have the similar kind of losses. So at present, in most of the states, the notified area is Gram Panchayat, village panchayat level. So each crop is notified at a village panchayat level. So productivity of any crop is established at a village panchayat level. Means at each village panchayat, one crop will have one productivity based on the crop cutting experiments which government is conducting. So if any area has a sown area, crop sowing is being done, and total sown area, out of the total sown area, if more than 75% of the area remains unsown for any notified area, then it is assumed that it is a case of prevented sowing. Means due to some adverse climatic conditions, farmers are not able to sow the crop, or whatever sowing they have done, that has actually failed. Means there may be germination failure or prevented sowing. So in that case, what is happening under the scheme? In that case, if farmers, there is a prevented sowing, means more than 75% of the area remains unsown. In that case, farmer is getting a claims. It is claim. I will tell, as per the schemes, it is 25% of the total sum insured. Farmer gets the claim, and since now there is no subject of insurance, so this policy is terminated. Farmer is getting 25% of the claim, and total sum, out of total sum insured in the initial period, not more than 25% is actually incurred by the farmer. Then it starts the cover from the germination up to the maturity. Then once crop is grown, germination is there. Up to germination to maturity, it is area yield index cover. Means crop is grown, at the time of maturity, productivity is coming, the yield is decided, what productivity is coming, and each area, each individual notified area has a some benchmark threshold yield. Means guaranteed yield for each area is decided, and based productivity, if the actual productivity of that area for that crop is less than that benchmark productivity, the ratio in which the yield is less, the same ratio claims will be paid to the farmers. So this is the, from the germination to maturity, yield index is covered. Plus in between these phases, there are localized covers. Means localized, some localized calamities are there, some perils are defined. Like in localized, 5 perils are defined, which are hailstorm, landslide, inundation, cloudburst, and natural fire due to lighting. So there are some localized perils. Due to these 5 perils, if there are losses in the crops, so in that case, individual field level assessment will be done, and based on that assessment, claims will be paid to the farmers. So this is one of the option. Plus in between the season, in between the season, there is some calamity, and it is estimated that due to this calamity, final yield of the crop in that particular area is going to be less than 50% of the average yield. This means that farmer is going to suffer a huge loss at the end of season, because in between some calamity of is there. So for to cover that cases, in this scheme, there is a provision of mid-season adversity claims. This is actually an advance payment of claims, because it is estimated that at the end of the season, some claims must be coming due to this calamity. So 25% of the estimated claims is actually paid in between the season to give the immediate relief to the farmers. So this is also one of the very good features of this scheme, that in between, if some calamity is coming and where it is assumed that it is going to result in more than 50% of the yield loss, then in between 25% of the estimated claim will be given to the farmer as an immediate relief, and final claim will be paid to the farmers at the end of the season as per the crop cutting experiment productivity. Then after the end of the season comes the post harvest. Then even after the harvesting, up to 15-14 days, if crop is there in the field for the purpose of drying, and there is some losses due to insured perils like hailstorm, cyclone, cyclonic rains, or unseasonal rains, in that case also, individual survey based claims will be provided to the farmers. So these are two risk and exclusions which is under PMFBY. Under WBCI, as I have already told, deficit rainfall, excess rainfall, temperature and humidity is there. And under PMFBY, these are the different kind of covers which scheme is giving. Yield index is the basic cover which is compulsory. Plus other covers, it depends on state to state. State can opt for any or one or all of the add-on covers, but yield index is the compulsory cover. So this is one photograph how weather station looks like, which captures the weather parameters for WBCS or weather-based protection of the scheme. So type of claims, as I already told, it can be on individual approach or area approach. Individual means some surveyor will go individually to the each field and do the assessment and give the actual claims. Area approach is all particular areas assumed to have same losses and uniform claim is paid to all the farmers of that particular area for a crop. So PMFBY is combination of both individual as well as area approach claims. So under claims, if you see the area approach claims, there are three types of claims which come under the area approach claims. First one is the prevented sowing, means farmers are not able to sow the field or whatever sowing is done, that is failed. So that comes under the area approach. Then comes the mid-season. Mid-season is also area approach, where for a notified area, if it is assumed at the end of the season there is going to be a huge losses, in that case 25% of the estimated claims is paid in between the mid of the season, and that will be adjusted at the end of the season claim. Then final yield losses claims are there, which is the basic feature of the claim, where final claims are decided on based on the productivity. Plus scheme also gives two type of individual farm level insurance, where claims are assessed on the individual basis, where surveyor goes to individual field. These are localized calamities, as I have already told, which due to 5 perils if there are calamities in between the season. And after harvesting, if there are losses due to 4 insured perils, in that cases, the post-harvest losses are also paid in the cases. So how end of the season productivity is measured? This is crop cutting experiments in each of the notified area. Government actually plans the crop cutting experiments. It is based on the random number so that secrecy is maintained, because of this crop cutting experiment at the Gram Panchayat, around 4 experiments are conducted in a Gram Panchayat, and average of that 4 experiments are taken for the productivity of a particular area. So whatever productivity comes for these crop cutting experiment, that represents the productivity of a particular Gram Panchayat. So secrecy has to be maintained so that there is no moral hazard in such cases. So government plans the crop cutting experiments for all the notified areas, and this is one of the picture where crop cutting experiment is being conducted. And based on the crop cutting experiments, productivity of each notified area, each crop productivity is defined. So how final losses are assessed? This can be seen by this end of the season claims, which is the base of the scheme. Based on the CC activity, actual yield is arrived for an insurance unit. Insurance unit is a notified area, means homogeneous area. At present, Gram Panchayat. For each crop, actual yield is arrived. Then actual yield is compared with the threshold yield of the IO. How threshold yield is calculated? Actually, threshold is, you can also call it as a guaranteed yield. Guaranteed yield is a yield which a government gives a guarantee that for a particular notified area, for a particular crop, this must be the minimum yield which we guarantee. How that yield is calculated? For calculation of that yield, what is being done? For the last 7 years, productivity is taken for that crop of that area. Out of that 7 years, best 5 yield. Of the 7 years, best 5 out of 7 years yield was taken. Average of that is taken, and it is multiplied by one indemnity factor which is decided by the government, and that becomes the threshold yield. Means threshold yield, you can call it as the guaranteed yield. That guaranteed yield is guarantees given by the government that their yield should be this much for this notified area. And actual yield, when it comes by the crop cutting experiment, that is compared with the threshold yield. If there is any shortfall as compared to the threshold yield, then the ratio in which shortfall is there, with in same ratio of the sum insured, claims are given to the insured farmers. So here comes the formula: threshold yield minus actual yield, means the shortfall as compared to the threshold yield. What percentage is the threshold yield? It gives the ratio, how much ratio is the negative deviation, and same ratio is applied on the sum insured to get the final claims to the farmers. So this is one of the alternate risk transfer mechanism. I will quickly go through this because this is one of the new things which government has introduced recently from after 2023. in earlier scheme, what is happening of the total claims, total liability is coming to the insurance company. Means in subsidy is being given in the premium portion. Or if actually out of the actuarial premium, the difference between the actuarial and farmer premium is given as the subsidy by the government, and full claim liability is on the insurance company side. But in the recent from 2023, government has introduced alternate risk transfer mechanism also. In this case, government has introduced three types of 80, 110, 60, 130 and 0350. What is happening in this case, full risk is actually not being transferred to the insurance companies. Like in 80, 110, what is happening? Out of the total premium, insurance company is liable to pay minimum 80% of the claim and maximum 110% of the claim. It means if premium income of a particular cluster are being paid, so you can assume as a state, suppose premium income for a state is 100 rupees. So in any case, insurance company has to pay 80 rupees, even if claims are less than 80. Suppose if claims are 60, then also insurance company has to refund 20 back to the government. So minimum liability of an insurance company is a 80 and maximum liability is 110. It means even if claims are more than 110, then insurance companies are liable to pay only 110. It means it is kind of a stop loss kind of arrangement where governments come in the picture after 110% of the claim ratio. So in this case, the risk are, after some limits, risk are actually transferred to the government. So in this case, what government started ensuring that insurance company are being liable to pay some minimum amount of claim, but after some limit, the claims again comes back to the government. So same is the case of cup and cap medal, where minimum liability is 6130 and maximum is 60 and maximum is 130, and third one is 01350. This is also one of the alternate risk transfer participation mechanism. So this is the very briefly I will tell how pricing is being done in the case of agriculture insurance, because I think almost we have crossed 1.5 hours. So in pricing, basic data cleaning is there, then threshold yield is determined on what basis deviation is calculated. Then pure burn cost is calculated. What is the pure burn cost, which gives the threshold at what is the burning cost for an insurance company for a particular area. Then this is adjusted with the adjusted burn cost with heterogeneity loading and data uncertainty. And then we do some loading or administrative cost and some margins, and then comes the final burn cost. Then how insurance coverage is being done, I have already told that there is centralized portal. In between what you see, this is the centralized NCIP portal. In NCIP portal, banks are the major stakeholders. Whenever banks are doing any loaning to the agricultural loan to the farmers, so if farmer is not giving any opt-out option, means if farmer is not saying I don't want insurance, then bank is going to insure that farmer. So bank is one of the channel partners which is doing insurance. They are insuring all the farmers who have not opted out of the insurance scheme in the insurance portal, and also remitting the premium in the portal. Then this is a CSC common service centers which is available in all the villages of the India, from where farmers can go and get the insurance. It can be through intermediaries, or directly farmers can go to the insurance portal and get their insurance. So this is the overall how NCIP portal is working. It is a centralized thing where everything is maintained, and all the stakeholders have access as per their requirements in the insurance portal. So now for the technology portion, I will request our technology expert, Mr. Senthil Kumar, to quickly cover through the technology aspects of the insurance.
Thank you, Mr. Karna. This is very thoughtful, and as you started the presentation, it's the agriculture insurance has more specifics or parameters more than the many of the general insurance products. But thank you for this very rich presentation.
At the end, we will take up the questions also, sir. We will take up the questions.
Yes. And I'll thank Mr. Kumar as well. Thank you, Mr. Kumar. Please, the floor is yours.
Yeah. Thank you, sir. for the time, and I think Karna sir has touched upon all the the ecosystem, for starting from the pricing to and enrollment. And now we will touch upon the technology aspect, how the technology is coming to the aid for implementing this particular crop insurance program, particularly in the context of Indian geography. And so in the current portal, in the current screen, you'll be seeing the National Crop Insurance Portal. So this is one of the first, one of the tech initiative by the central government, from the government of India, which will take care of the underwriting processes, like actually the acceptance and monitoring whether whether they're able to cover all the farmers to whom the scheme has been implemented. And I'll be touching upon the technology which is helping the loss assessment, especially which for the computation of claims. So the how is technology helping the crop insurance? So in the earlier slides, actually, when Mr. Karna sir was explaining about the crop cutting experiments, or the conventional method where the losses are assessed. So, Sir was mentioning that actually we in India, the scheme is implemented at an area approach method, wherein around example like sampling, like some sampling method is used. Supposing like 4 crop cutting experiments are done in one insurance unit, and whether that data is representative or not, so that became a challenge over the years. So that is where the technology is trying to come to the help of the help in assessing the losses. So here what we do is actually it provides you the factual data. So here what happens is like actually it will be capturing the data of the entire insurance unit, and that entire data of that entire unit is collated, and we will be able to arrive at one single number which will be representative of that particular insurance unit. Here the chances of error is minimal. So that is where actually we are able to have an factual data and the synthesized from multiple input indicators. Meaning is, so here we are not going to capture only one information. Here we will be trying to capture the information across the season. Supposing in India we have two seasons, major seasons is Kharif and Rabi. And if in the season the entire crop cycle is running for 90 days or 120 days, the satellite is able to capture the information throughout the season, and this information is being again collated, and based on which we will be able to arrive at the health of the crop, and that health of the crop in turn indicating what could be the yield for the particular crop. And as I said, is the input indicators covers all the crop stages, and here it is highly compatible because of its uniform methodology, because the methodology which can be applied in zone A can be applied in zone B. So we will be able to have an uniform methodology across the different geographies and across various risk parameters. And the major thing is actually not prone to manipulation, because you know that actually in insurance, actually the insurers face the major challenge the insurers face is the moral hazard. And using the technology tries to plug that particular gap, and wherein we will be able to have an near error free yield estimation.
Mr.
And
Kumar,
of course, like that.
sorry,
Yes,
sir.
sir. Yeah.
Do you think that we will be able to wrap up this part in 10 minutes, that we can have 5 minutes
Yeah.
for the questions and answers?
Yeah.
Thank you
Yeah,
so
sure.
much.
I'll run through the slides. Yeah, sure.
Thank you so much.
And with the technology, we were able to reduce the claim settlement period now which is now the need of the hour. And going to the next slide, how the I'll just tell you like how the remote sensing works. So basically, like for anything, we will be requiring an basic data sets. So one is in a vector data, and then the raster data. Raster data is nothing but pixels in a digital photograph. So any value represented in that particular format is called as a raster, and the vector is something like that. Actually, roadways which you see in a Google Maps. So this collecting this two data, you will be able to get an overview of like how the Google Maps works. So in similarly, like the in remote sensing also, these two data sets are being used for providing some kind of providing an information. And upon that, we will be recurring ground informations. So this ground information is recurred to validate the informations which has been captured remotely through through these satellites. So of which the major activities is the ground truthing. As the name says, truthing. So the field functionaries will be visiting the field and will be capturing the actual information, and that will be validated from the validated what the satellite is going to give you. And how are we doing it? So this is one of the IoT devices, or it will the mobile applications, or the mobiles which is being used for capturing various informations. And the first three applications, mobile applications, are provided by the central government, which is uniform for all the insurance companies in the country. The first one is the crop cutting experiments app, wherein all the crop cutting experiments are captured through this mobile application. And the second is the Cropic, wherein in India we are trying to capture informations through the image processing, wherein this images which is captured through this mobile application will be used for data analysis and processing. And the third is the CLAP. So with this application will be capturing information wherever where
Mr. Kumar, apparently there is some internet interruption because we lost the last 10, 15
and individual losses, that the add-on covers which is being states. And the yeah, hello.
Last 10, 15 seconds. Just
Last 15 seconds. Okay, right. Okay, so I was a bit worried actually. So
yes.
Okay. So this mobile application, is the we have around 5 mobile applications, and the 3 applications are from the central government, from the government of India, and the 2 is from the AIC, which has been developed in house. And the first 3 applications are used for various activities for assessment. One is for the yield assessment. The first application, mobile application, is used, and the second is for the image analysis, which the country is developing for doing an image analysis. And the third application, the CLAP, is used for the individual loss assessments. Whenever there is an individual loss assessment in the loss assessment, this information is captured through this mobile application. And the other 2 applications, which is an in-house developed by agriculture insurance company, which is one app is used for your enrollments across the various segments of the insurance provided by us. And the second AIC form is the application which is used for collecting the ground truthing informations, because this ground truthing informations, which is important, as I said, it will be used as one of the parameter or one of the threshold for computation of any technology based yield. And how does the technological framework work? Here the satellite data is captured, and here the flexibility of technology is that actually it is not only it is not that actually it can be only done for the current year. You can do it for the past years also. That is the one biggest advantage and flexibility of a technology. And so simultaneously, if at all any new geography is going to come in, then we will be capturing the current year's information and the past year's information, and we will be running through the models which has been arrived or which has been approved for the current years and the historical years, so that we will be having an information which is similar across all the years. And based on this data, we will be able to capture the risks affected for any crops, and modeled yields can be used, which I'll be discussing in the upcoming slides. And this particular data sets will be used as a proxy index for the performance of particular crop, as I said in the earlier slide. And this index will be representative of the performance of the crop, and based on which the yields will be computed. And as per the technology initiatives by the country, so we have the major three technologies towards the loss assessments, and one towards the enrollments or the for the farmers to join the particular scheme, and one is for the disbursements of the claim. One is the STEC is one model which is widely used for the PMFBY scheme, and WINS is widely used for the weather-based scheme. And of course, this data is also used largely for use for any dispute resolution under the PMF-based scheme. And cropping, as I said earlier, this is an application or an initiative wherein we will be using the images for validating or identifying the health of the crop at that particular time of the stage of the crop. And DigiClaim is another initiative which is a part of the NCAP portal, where the any claims will be directly disbursed or paid to the respective farmers. So with the DigiClaim, the entire ecosystem comes to an end, where the enrollment starts, and through DigiClaim, the claims will be settled to the farmers. And AID is another one application wherein the informations or the farmers can enroll through in the scheme through this particular mobile application. And when we are talking about PMFBY, so when we talk about the technology used in PMFBY, these are the 5 models which has been accepted, and it is being widely used, and it is a part of our documentation here, that any technology assessment using this particular 5 modules is accepted, and it is being based on which the yield is being calculated, and upon which the claims are getting settled. So I'm not going deep into these models because of due to shortage of time. So one is the semi-physical model, and the machine learning model, and the crop simulation. Semi-physical is nothing but actually it is capturing the structures and the health of the crop, and it tries to capture all the biophysical factors which is happening in the crop during the entire crop cycle, and based on which the again and a computer neural networks, and according based on which the yields is getting calculated. And crop simulation, again it is again a simulation. So we widely the data is getting simulated. That is, the particular module will simulate what could be the yield for the current season. And the CHF, the crop health factor. So probably we can say that actually AIC was the one who has introduced this crop health factor, along with the nodal agency for through ISRO. And this model is again an combination of various parameters which will provide you the health of the crop, and based on which the yield is getting computed. And ensemble model is again, it is a combination of either of the earlier 4 models. It will try to improve the accuracy, and this is mostly a kind of an R&D initiative. And here either of these 2 models is being used in this particular model. And next, coming to the WINS technology, WINS is nothing but it is a portal wherein the Government of India's initiative to collate all the weather data in one single portal, which can be made available to all the stakeholders. Stakeholders means the central government, or the respective state governments, or the insurance companies, who will be able to view or access the data. And this particular data is being used for computation of or calculating the triggers for the scheme, like for the WBCS scheme. And next, as I said, this is the Cropic. It is in an implementation phase. It is an R&D phase, and it is yet to be implemented. But again, here the images which is captured by the field personnel through the form application or through the Cropic app is collected is made as an input parameter in the system, based on which the system will be providing you various information, be it the health of the crop, or the irrigation status, water stress, if there is any water stress, and what could be the yield. So these informations will be collated, and it will be providing you the information. And from the Government of India side and the AIC's initiative. So AIC's initiative, we have one such project called as Chandra Tech within one of the state in the country, wherein we use the drones to see the feasibility if we are able to do an individual loss assessment at any given point of time where the human people cannot reach due to the considering the calamity happened during the period. And Kesar is another one R&D project wherein we try to be connected with the young minds. And here we have associated with one of the famous university in Kashmir. And here we try to exchange informations. The industrial experience is being shared to the students, and the students are providing their inputs in using the latest technologies. And coming back to the remaining sessions, I will hand it over to Karna sir for taking it further. Thank you.
Mr. Mukhtar will just
Thank you.
close it now. Just 2-3 slides before we close. This is the complete crop insurance ecosystem where farmers are there. There are rural financial banks which does the data entries and put the data in the portal for coverage. Then there is a technology for the assessment of claims, and finally through the portal itself, farmer gets the claim. And before we close, just some growing footprints of the AICL. At present, we are doing insurance in 16 states out of 24 participating states, around 67% of the India, and 252 districts out of 468. We are doing 54% of the total and 55% of the. And if you see the market share position, you can see the market share is now growing. In 2022, we are at 43%, and in between, our market share is reduced. But now in this year, we are at 48% market share. So we are continuously a market leader in the Indian market. And these are the allied line of insurance which we have started since 2022. These are some of the products like indemnity products such as cattle, shrimp, aquaculture, and irrigation, plus parametric products and hybrid products. We can give details in other presentations because there is a lack of time, and you can visit the websites of the AICL for details about these products. And these are the operational performance of the AICL. Net worth is 24-25 is 947 USD, and we have a strong solvency margin of 4.07, which is one of the best in the industry, I think. And incurred claim ratio, if you can see, in 2024-25, it is at 80.43, and we are one of the few companies which are operating at profit margins and combined ratio of 86.52. So this is all from our side. Thank you, sir. And any questions we can now address.
Thank you so much indeed, Mr. Karna and Mr. Kumar. This was very insightful. I have actually a couple of questions, and I don't know whether we can have them in 5 minutes or to answer them, because as
we can try. Otherwise, we can connect through mail also.
Yes, this is actually one of the requests from some of the participants, whether we can share with them your email and contact details.
Yeah, you can share our emails. Okay, we can connect through the email. And I think actually this 2 hours is too short for a subject like that.
It's a thought for food for thought, as they said, Mr. Karna. The other thing, Mr. Karna, can we share the presentation with the participants, if you don't mind?
Yeah. You can share.
Okay, so we'll share the presentation and your contact details with those who have asked. Now, if you can allow me, there are a couple of questions. We can quickly throw them. One was asking, to what extent can the insurance market successfully achieve penetration in agriculture sector in case of absence of government subsidies? Like, in some countries, the government did not take the initiative to step in and subsidize the premium. So how these schemes can work if there is no government subsidies, knowing that the farmers are usually, do not have much to spend on insurance?
As I have told in the introductory session itself, that crop insurance, if you see the loss cost of the historical loss cost, then claim ratio, if you see the loss cost, it comes to above 10% or above 15%. So in case of developing country, what I think, and if you can see through the examples also, it is very difficult to penetrate the market without the help of the government. because farmers in the developing country, they're economically not that much strong, so they don't have the paying capacity. So
Yes.
first thing, they have to secure their current, then they will secure the future, or they will take the production. If they don't have the money, they can't do. So in the developing countries, without government subsidy, it is very difficult to penetrate, because even if they want, they can't purchase that thing. In
Yes.
developed countries where farmers are well off, they have a good financial conditions, there it can work out, but in developing countries, very difficult.
Yes, I fully agree with you, sir. The other question is one was asking, how can parametric insurance model be effectively applied to agriculture insurance products, and does it suit most markets? And what are the main challenges associated with the implementation, the parametric insurance?
Parametric insurance, the main challenge is that in parametric insurance, what we assume that the particular weather parameters that has a correlation with the yield. So as different weather parameters play different correlation, they have different correlation with the yield. So first thing is you have to establish correctly the correlation. So correlation may not be established correctly. What you think a 10% deviation in the rainfall may result in 10% deviation in the yield, that may not be perfect in all the conditions. So first thing is correlation. Plus second thing, even if you are doing correct correlation, that sometimes due to uncertainty in the climatic and weather conditions, the premium rates may go too high. So if it is a government supported project, sometimes the insurance company will have a pressure to reduce the premium. In that cases, when you change the triggers, if you change the triggers, automatically the correlations goes out. So even if there is a loss in the field, the actual weather parameters based on the triggers, it may not show the losses. So because since it is a derivative product, it may not reflect the actual pictures. So
Yes,
correct correlation and pricing is one of the major challenges in the weather
indeed,
insurance.
parametrics. Yes, thank you so much, sir. One more question or two more. In case of a countrywide nat cat, like a flood or a hurricane, which will damage large areas, how you are able to settle the claims? I mean,
If you see in context of India, if I will tell, India has a very diverse geography. So in some areas, if there is a drought, some other areas there is a flood. So overall, as a whole country, if your geography is very spread, that is, it is very extreme case that you will have calamity throughout the country.
yes,
And in case of scheme, if you see the schemes, there is a 50% cap is given by the government itself, where government comes in the picture about the 50%. And as such, I have shown the alternate risk transfer mechanism. In alternate risk transfer mechanism, government comes in the picture even after 110% and 130%. So that takes into care, and insurance company takes the upper coverage also, in like stop losses they are taking. So in a spread geography, if risk is well spread, then risk is not that much. If risk is
exactly.
concentrated in some particular area, or area is small, only that cases risk is more. Actually.
That's right. Yeah, particularly if the country
So
area is
agriculture
small.
main thing in insurance spread is the main thing actually.
Yes, that's right, sir. The last, I think, question, someone asked about if they would like, or if we can elaborate more on the crop health index, but I don't know whether we can do that in 1 minute or two. Do you mind, sir?
Crop health index, actually crop health index is it is type of index through which we can assess what is the condition of the crop, means how healthy is the crop. So there are various parameters, and these parameters are actually mainly captured by the satellite imageries, where satellite captures the picture, it gives the texture of the crop, and based on the reflection, what infrared rays are reflected, that is captured, and through that various indexes are measured, like NDVI I have told, soil moisture index is there. Like NDVI measures the how much greenness is there. So satellite takes the picture, and based on the picture you can assess this much greenery is there. This means the crop is in this condition. Like soil moisture is there, is soil moisture. If moisture is more, reflection will be less. Such kind of things are there. So based on index, you can see what is the moisture content in the soil, what is the greenness in the leaves. So on that parameters, you decide either you decide this much health factor is actually required in the healthy crop. If the factor is below that, index is below that trigger, it means crop is suffering some loss, and the deviation of that as compared to the threshold that triggers will give the estimation of the losses. This is actually a basic idea of the crop health factor. Means some parameters you are capturing through the satellite, and that you are comparing with some standard triggers.
Yes,
That is
it's
a
something
basic
like,
function.
yeah, like the skin health. You can see how dry is the skin, or smooth, and whether the
Yes,
nutrition. Or yes, I get your
yes,
point.
yes, yes, yes. It is also like a correlation type of things in that
Exactly.
you can estimate that this is the crop health. So green is more, moisture is more. Based on that, you can actually estimate what is the health of the crop.
Yes. The sir, one question or request was if we can share, if you could kindly share with us a couple of sample of policy wordings, so that also the people can read and study, and perhaps can come back with some of the questions. The agriculture
Policy
insurance
wording.
policy wordings.
Sir, actually, this crop insurance, this PMFBY, everything is done through the portal. So
Okay.
from the portal itself, the CSC centers give the printout, and we will send you the sample what is there. But
Yes.
as such, it is available in the portal, and anyone can go and insure. And as such, policy is not there. In case of farmers are covered through the banks, they will get a मेरी policy मेरे हाथ, one policy type of document, receipt type of thing they get.
Okay.
So we will
Great.
send that sample to you, sir.
Thank
That
you
has
so
a
much
basic
indeed.
idea. And anyone can visit pmfby.gov.in. That is a
Uh,
centralized government portal. It has the dashboard as well and gives the scheme details. And aicofindia.com also you can visit. There also various details of the schemes and our own products are available. There also you can get the idea.
Thank you so
And
much indeed.
and
Yes.
anyone can connect with us through email also. We will
Yes.
be happy to answer the queries if any.
Of course, sir, that will be. I mean, this is very kind of you. We are grateful for your time, for Mr. Kumar's time as well, for the wonderful presentation. We would like also, before closing, to again repeat our thanks and gratitude to Dr. Lavinia for giving us this opportunity, and also for her kicking off this presentation. And as we all agreed, and you have kindly offered that you are willing to take this presentation to the next level, so we'll agree together on what will be the suitable time and content of the presentation. But for now, I'm sure the participants got a lot to think of, over the weekend or the next few weeks. But this was very insightful. Thank you so much indeed, Mr. Vinod Karna. Mr. Kumar, and please convey our gratitude and many thanks to Dr. Lavinia as well.
Okay, thank you, sir. It was pleasure for us participating, and happy weekend and happy new year ahead, sir.
Yeah,
Thank
thank you,
you so
sir.
much
Happy
indeed.
New Year to all.
Happy
And
New
happy
Year
new
to
year
all
to
of
all the
you.
participants as well.
Yes, and all participants, thank you so much indeed for being with us, for your questions. My apologies if we could not pick some of the questions, but I tried as much as I can. We look forward to seeing you again and your participation in the future events of the Federation, in collaboration also with the AIC, Agriculture Insurance Company of India. Thank you so much indeed, and have a great day, and Happy New Year to all. Shukran.
Okay, thank you.
Thank you, sir.
Thank you, sir.
Bye-bye.